Hello again, traders. This is Jeff, the Day Trade Mechanic. In today's video, I want to talk about how to calculate average cost in a stock trade, dividends, reducing your average cost, and covered calls. We're going to use Amazon as an example. I have a really close friend who has a position in Amazon, and he is up to 100 shares. I don't know all the buy points. I do have an idea of the average cost, but all these numbers are going to be fictitious just for our purposes today. So let me get rid of this day trade grid and bring in a daily chart of Amazon. So this is what Amazon's done for the past several months. Now I have my spreadsheet loaded with about a 75 share trade right now. Okay, these are just some imaginary buys that I placed the last few weeks. We have the date, quantity purchased, and over here the price we purchased at, and then this is just a calculation of shares times share price to give us a total. So right now we got a 75 share position. We've got a little under $8,300 invested in the trade. How do we create average cost? How do we calculate that? Well, I'll bring in the Windows calculator, and it's really pretty simple. We'll just enter in our total purchase price, which is $82.87.50, and we'll divide that by 75 shares. And that gives us an average price so far of $110.50. Now, there's going to be one additional buy in this. Let's bring up the chart again real quick. Let's just say you timed this trade perfectly, and on November 9th, you purchased shares at $86, which would have been near the low of the day. So we'll bring in the spreadsheet. 11.9, we did 25, and we got filled at $86 even. And that gives us 100 shares with a total cost of $10,437.50. And just to make sure we're right here, we'll auto sum this again. Okay, so let's calculate our new average cost. So we've got $10,437.50 divided by 100 shares. So our average cost is 104, let's just call it 38. Okay. Now, I know my friend likes stocks that pay a dividend, but unfortunately, Amazon does not. We'll bring up the Analyze page here on Thinkorswim, and we see that there are no dividends. And here's another site I like to use. I like to use NASDAQ. Just Google up NASDAQ and the stock and dividend. So there's no dividend history here. So how in the world are we going to get Amazon to pay us a dividend when they don't pay a dividend? Well, we're going to start selling call options against our position. That's how. Now, I've brought up the trade tab in Thinkorswim, and I've got the option chains brought up. Now, the November 18th monthly options are the first to expire. They'll expire on Friday, the 18th. And they're listed in white. And for many years, options were only traded monthly. But several years ago, some of the higher volume ETFs and the higher volume stocks started trading weekly options, and these are shown in yellow. So for a lot of the stocks and ETFs out there today, there are weekly options available to trade, and for our example, we're going to trade weekly options. So really quickly, what the heck are calls and what the heck are puts? Well, generally, if we're bullish on stock, we'll buy calls or sell puts, and if we're bearish on stock, we'll buy puts or sell calls. Now, option buyers have rights, option sellers have obligations. This is something I found that I think explains it pretty well. So, in our case, since my friend likes to collect dividends, we're going to sell options and we're going to collect premium. So, let's look at the chart here for call options only. Now, somebody's going to buy that call from him, and that person has the rights. That person has the right to buy the stock at a specific price by a specific date. Now, my friend is the option seller, So he has an obligation, and his obligation is to sell stock to the call buyer at a specific price by a specific date. In both cases, the option buyer pays a premium, the option seller receives a premium. Now, for any of you that follow me on this channel, you know that I'm a premium seller. I rarely ever buy premium. Now, I want to quickly change my layout here because I've got this scrunched up for the sake of the video. And let's just customize something here. Real quick, I want to bring in just a few things. And I think we'll have it kind of the way I like it for this example. Okay, how does that look? Okay, now I want to direct your attention on the left side because these are call options. On the right hand side are put options. And we're going to use the monthly November 18th expiration and have 2+ days until expiration. So right in the center is the date, and these are the strike prices. Now, what's a strike price? Well, a strike price is where a call buyer would be able to buy the stock and where a call seller would have to sell the stock. So we're going to need some more strikes here pretty quick. But I want to direct the attention now to the bid-ask columns. The ask is the lowest price someone is willing to sell an option for. The bid price is the highest price someone's willing to pay. And there's always going to be some kind of a spread. Generally speaking, you're going to get the worst price. You know, if you're buying, you're going to pay the higher price. If you're selling, you're going to get the lower price unless you're willing to sit for a while and wait. Now, one more thing. Option contracts, one contract controls 100 shares, but options are quoted per share. So the bid-ask of any option is quoted per share. So let's look at these $99 strike price calls here that are $1.03 by $1.04. They just went up a penny. So let's say we want to buy this. So we're going to pay $1.05 per share, but we have to buy, or one contract controls 100 shares, so we'll multiply that by 100. So that option contract is going to cost us $105 plus any fees or commissions. Okay, let's jump back to our spreadsheet, and we know we've got 100 shares, and we know our average cost is $104.38. And I'll just bring this over again on my spreadsheet, and I've got it calculated here. Our average cost is $104.38. So where would we want to sell call options at? What strike price? Well, I always like to take a look at the chart, and I'm thinking, you know, there's some pretty good support up around this 102 area, and there's some pretty good resistance up around this 105 area. But keep in mind, our average cost is $104.38. So if we sell options with a strike price of 104 or less and we get exercised, we're going to lose money on the trade. So I think we want to sell options with a $105 strike price or higher. So let's bring back our option chain, and we're going to look at the November 18th first, and we're going to need to bring up some more strikes. Okay, this is good. Okay, so the 105 strike price right now, which you can see here is highlighted in gray, and over on the left side is the calls. These options are trading by 11 by 12 cents. So if I'm a seller, I can hit the bid and I can get 11 cents or $11 immediately. That gives the option buyer the right to buy my shares for $105 between now and the close of business on November 18th. Now, these columns here actually all mean something. I like the last X. That's the last price traded. So in this case, the last price traded on this was 11 cents. The volume. Amazon's going to do a lot of volume in options. There's been well over 17,000 contracts traded today, and those contracts have been both purchased and sold. the open interest. Now, as far as I know, this will update tomorrow, but the open interest is the current number of open contracts, and those can be long or short. So you want to trade stocks. If you're going to trade options, you want to trade something that's got good volume and good open interest, and Amazon certainly has that. Now, theta is one of the Greeks, and without going into a big, long thing on Greeks, theta is the amount of money an option will theoretically lose per day. Now, this option they're saying is going to lose 11 cents a day, but we have 2 days till expiration, so there's going to be some premium left on Thursday or Friday, but it's going to be substantially less. Now, this column here says prob OTM. Well, what does that mean? Well, this is the probability that this option will expire worthless or out of the money. If if Amazon closes 105 or above on Friday the 18th, this option will expire worthless and out of the money. So right now, the out of the money options are any strike prices that are over the current price of the stock. So the 97.50s and above are all out of the money right at the moment. Conversely, on the put side, all the options with a strike price of 97 or less are out of the money because they have no real value. And that's, again, a whole nother discussion, real value and time value. So for our example, let's say we go ahead and sell this 105 strike, and we've lost a penny on our bid ask, so we're only going to get a dime for it right now. So let's adjust our spreadsheet real quick. Okay, so we took in $10 of premium by selling this 105. We've got a 2.5 day hold. So isn't that like getting a little bit of a dividend on Amazon? I think so. It's only $10, but we can do this week in and week out if we're not too far away on price. And another thing, what does this do to our average cost? Well, it's only reduced our average cost by 10 cents because we've only taken in $10 worth of premium. But let's see what happens as we go forward. Okay. Now I'm jumping out to November 25th expiration, and you can see that there's more premium in these options. And the reason why is because there's more time to expiration. There's 9.5 days to go. There's good volume and there's good open interest, and the bid-ask spreads are tight. So let's just assume that we expired worthless on the 18th, and let's just say the stock's trading the same as it was. And let's sell that 105 strike call, and we can get 50 cents for that. So let's do that real quick. What is today? Today's the 16th. Let's just say it's the 21st. Let's say it's Monday the 21st. And we sell that 105 call again. And that date was what, the 25th? And we got, what did we get, 50 cents for that? And for right now, we're not paying any fees or commissions. So now, what have we done? We've taken in another $50, or we've got $60 total premium. I don't like this. Let's fix this real quick here. Let's fix all these. And let's just center it. There we go. So now we've taken in an additional $50. We've sold the 105 strike, and we've got $60 total premium. And we've also reduced our average cost another 50 cents. So our average cost now is under 104. We're down to 103.78. And we have $60, which is ours. We've taken that in, and we're going to say that the 105 call that expired on November 21st expired worthless. Okay, so going out in time, we can see now that we have more premium available. We've got good open interest, we've got good volume, and the bid-ask spreads are tight. So this time, my friend is telling me, Jeff, I want to make some money on the stock this week. You know, we've sold some premium that's at my cost, and I've taken in $60, but this time I think Amazon might take off. Let's sell something that's let's sell something higher up and see if Amazon appreciates in value, that I can take in a little bit of premium and sell my shares. And I said, okay, that's great. So where would you like to sell those shares at? Well, let's take a look at the chart again. And let's say we think that there's some pretty good support, maybe some resistance up here around this 112 area, in between 110 and 112. So he says, Jeff, pardon me, I want to sell up around 110, 112. So we'll add a couple more strike prices. Well, we'll add a few more strike prices. So we can sell up here around 110, 112, or we can almost get 50 cents for a 110. We could get 35 cents for a 112, or we could get 41 cents here in the middle. Why don't we just cut the difference and do the middle here? So we know we could get 41 cents. So let's go ahead and do that. So this is going to expire on the 2nd of December. We'll bring back our spreadsheet. Now, let's just say we did this trade on the 30th of November, which would be, I think, a Wednesday. And we sold the 111 call, and it's going to expire on the 2nd. And what did we get for that? 41 cents? I think we got 41 cents. Yeah, we got 41 cents. Whoops. Whoops, I didn't want to do that either. Okay, and we'll auto sum that. So now over 3 weeks, we've taken in $101 worth of premium. They haven't taken that out of the share price, so it's like we've received 3 small dividends on our Amazon stock, and we've reduced our average cost by $1 and a penny. So our average cost now is down to $103.37. So we'll go out another week here. So we're going to go out to December 9th now. We're going to sell our final covered call. And let's say we're not as bullish on Amazon. We think it's going to close, maybe in the 108, 109 area. And keep in mind that I am using all the data from today, which is November 16th. So I'm having to go out further in time, which is not really that valid, but since the stock price is the same, and this is just an example. So this time we're going to sell the 108. And we're going to hold out, and we're going to try to get $1.01 for it. So Amazon's going to have to increase a little bit in price for us to get that $1.01, or we could just hit the bid and get 98 cents. Now there's $1.01 on the offer. Now we could put our call on the offer and we might get hit, or we could put our offer at $1 and I'd say there's a very good chance we'd get hit. There we go. Okay, now we know we could get $1. Let's say we're going to get $1.01 for this. So what was that expiration date? The 9th? I believe it was the 9th. We got 101. No, sorry. We did this on the, let's say on the 6th. And we did the 108 strike. I'm sorry, 108. We're doing calls. And we got $101 for that one. And we'll auto sum this, and that's going to put our total premium up, I believe, to $202. Yes, indeed. So we'll bring this over now, and we've reduced our average cost down to $102.36. So we've taken our average cost down $2. We've taken in pretty good premium 3 of the 4 weeks we've done this. So let's do it one more time. And this time we're going to get called away. So my friend, he's saying, I'm kind of tired of being in this position. I've made a little bit of money on it. But I think that Amazon's just not going anywhere, and I just kind of want to see, what happens elsewhere. So let's take a more realistic example here. Let's go back to front week premium. And no, that's not what I wanted to do. Let's just go out 2 weeks. Let's use this premium, and we're going to sell right at our new cost. No. Let's not do that. Let's sell at our average cost. What I was getting at here, we could sell 103 premium, and we would be giving up some of the premium we've made because we're selling at our net average cost, not our average cost. Let's just continue and let's sell 105s or higher. So for our example, let's use November 25th premium, and we're going to sell the 105, and we can get 52 cents for that. So let's add this to our spreadsheet, except I'm going to change the dates. So this would actually be the 16th, right? This would actually be 12/16 expiration. We're doing a call, and we did the 105, and let's just say we did that on the 12th, 12/12, and we got 52 cents. And that didn't come up as currency, so we'll change that. So we've taken in $254 of premium. So we've collected a little bit of a dividend on a non-dividend paying stock each week. We've taken in $254 in call premium, and we got called away this week. So we're going to sell at $105. Okay, I just added a little something to the spreadsheet here. So we sold all of our shares at 105. So we lost money on some shares, but we made money on our other shares. So we made a grand total of $62.50 on the stock, and we made $254 on the options. So we made $316.50 on this trade. We're flat. We got our buying power back. We can go on to the next trade. Well, I think that's all we have for today. We've taken a stock. We've learned how to calculate our average cost. We've looked at puts and calls and what they mean. We've taken in call premium by selling covered calls on Amazon, or we've collected a little bit of a dividend on a stock that doesn't pay a dividend, and we netted out $316.50 on the trade. We're flat, of course, less commissions and fees. So I think that's all for now. If you like this content, give the video a like, maybe even subscribe to the channel. Until next time, this is Jeff, the Day Trade Mechanic. Thanks for watching.